What is up, guys? It's your boy T-Shroom here. I'm extremely excited to bring you some okay news. We're going to interpret what the CPI miss means for you, what it means for your portfolio, what it means for the markets generally, guys. We're going to be getting into it, but I'm not going to be doing it alone. Yes, Tim is still in Maine snowboarding and having way more fun than I am, but I am joined by one of my favorite people and a huge friend of the Investing Bros, Caleb Franz. I'm going to bring him on now. Caleb, how are you doing this morning?
Guys, good morning. Stoked to be here. I'm on my second cup of coffee, so we're still waking up, but the CPI report gave us a nice little extra wake-up call, so happy to be here.
Absolutely. Well, guys, I am extremely excited to talk about this. It's been long anticipated. Seeing in the chats, people are giving away kind of the bacon here, saying it's 6.4. That was the print, 6.4, and the forecast, I'll go ahead and show you guys. The forecast was for 6.2. So it was a miss on headline inflation. So that is bearish. And then it was also a miss on core inflation. So core inflation came in 5.6, forecasted for 5.5, but it came in lower than previous, right? So making progress in the right direction. And so did headline, obviously made progress in the right direction too. But will it be enough is the question that Caleb and I will be tackling this morning. Is it enough? Is this something that's going to spook the market? Is there going to be a huge sell-off now in anticipation for Jerome interpreting the Fed interpreting this as ultra bearish? So far, just in our conversation with Caleb here, we are still unsure, but we're going to unpack all the data that Caleb's brought to the table and that I brought to the table, and we're going to find a decent conclusion of how we think the market is going to interpret this and what we can expect. So we're also going to get into a couple of stories that are Paxos and Binance related, as you might imagine. But before I do that, I'm going to go ahead and jump into the chat here and see if Mr. J was first to chat, and he was not. He was actually, looks like he's number 6 or something. Crypto Mini Bike was number 1. So give it up for Crypto Mini Bike. Said, good morning, everyone. And he said, never been first before. So that's super cool. Also, Steve B getting in there with the thumbs up and the rocket emoji. Guess he didn't see the misprint. That's all right. Just messing with you. And then we got a Mellow Fellow, Yar Navarro, Henry C. Hernandez, John Kahn, and Justin Eubanks. Mike Play and said, what's up, bros? Elo Brown said, is 6.4 higher than anticipated? And Elo Brown, the news is yes, it is higher than anticipated. And Caleb and I are going to unpack if that is something that you should worry about. Also, something from Steve Shrum, my father, tuning in. Thank you so much. Said, hi, where is Tim? Just kidding. So always coming in hot with the jokes, my dad with the dad jokes. Cool. So those stories, thanks so much, guys, for tuning in. Definitely leave us a like here in the first couple minutes here of the show. And I'm going to also go ahead and get into what the stories that we'll cover here after the market open at 9:30. But first, we're going to unpack, obviously, this miss in the CPI print. So those stories are: Paxos says it's prepared to vigorously fight SEC lawsuit. The FTX Turkish entities dismissed from U.S. bankruptcy proceedings, so that's interesting. And then the BNB token plunges as Binance Paxos shutters BUSD stablecoin product. Don't worry, though, guys. I already took a look. Binance is not plunging. The headline is misleading here. And then also Biden has announced a new economic advisor that has could have some crypto implications. So we're going to cover all that in the second half, guys. If you guys see any news, feel free to copy in the chat and we will tackle that as well. But let's go ahead and dive into this CPI print. So Caleb, I want to toss it over to you. 6.4 was the print, forecasted for, was it 6.2 for the headline inflation. So that's off by 0.2%. Is that enough to spook the markets? And should we sell everything we own right now?
No, absolutely not. It's obviously a miss versus those expectations, but I think for the people who were kind of closely monitoring some data that kind of got snuck into the news stream late last week, we got an upward revision for the December 2022 data. So, it was initially reported that we had negative 0.1% headline CPI on a month-over-month basis. That was revised up to positive 0.1%. The year-over-year rate of change increased from 6.4 to 6.5%. So we kind of had this little modest increase. Some people who were, absolute market junkies like myself were saying this doesn't bode well for the January CPI data that we were going to get today. And so I think we had this very kind of like divergent perspective of people saying that, we're absolutely in disinflation and it's going to continue to come in lower and lower than expected because that's what's been happening for the past several months, versus other people who were saying that it's going to come in way hotter because look at the revised data. I fell kind of in the middle of that. I did somewhat of a facetious thread on Twitter yesterday, and I was like a preview of tomorrow's CPI data. And then I did one tweet after that and it just said disinflation. And that's exactly what we're seeing, right? So nonetheless, even though this was hotter than expected, the year over year rate of change fell from 6.5% to 6.4%. It's a modest decline. It's certainly nothing to celebrate, but it's certainly also not anything to be necessarily in fear of. And so I'm sure we'll go into the weeds a little bit more, but kind of across the board, we're seeing that disinflationary dynamic on a year over year basis. Energy prices were up slightly month over month. That's not a surprise. T-Shrim, you and I were talking just before, and I did a post about this earlier this morning about crude oil prices in Cushing, Oklahoma. Those increased slightly on a monthly average basis from December to January. So again, I wasn't necessarily surprised to see that. In my opinion, this really just kind of came in line, at least with how I was seeing things. So for me, it was somewhat of a non-factor. And, we saw the market initially tank in response. S&P 500 futures, Bitcoin all wicked lower.
Right.
A minute later, they were up higher on the session, right, in the futures market in Bitcoin. And now, everything is kind of starting to settle in again, right? It's like, all right, yeah, we're having disinflation. That's a win. But is it going as fast as we expected? No. Okay, so the market's trying to figure out what it means.
Exactly. That is the name of the game, is seeing what the market is going to do. Well, I'm going to go ahead, since you brought it up, I'm going to go ahead and flash over to some charts. And I'm surprised actually that I'm the first one bringing up charts today. Usually when you have Caleb on, he is quick with those charts. But here we are, guys. This is the S&P futures that Caleb was just referring to. And as you can see, it wicked all the way down. Let's see what kind of percentage. It wicked down from about 0.4, so very, very little. And then it tested higher, up 7. So it's actually been up higher this morning in reaction to this miss than it was lower. And I'm also going to zoom over here, guys. This is the inflation chart here that goes back quite a ways. We're back to 2016. But what's relevant to us is where this peak is, because some of you may be tuning in here and you have no idea what we're talking about. What is CPI? What is inflation? Well, we're not going to talk about that, but I'll give you a little bit of historical context about where we've been with inflation. So as you can see here, guys, back in 2021, February 1st, we broke out of where the Fed's target rate is. So that if the Fed sees that inflation comes out of that 2% target rate, the alarm bells start going off over at the Fed. They wake up Jerome Powell and they say, Jerome, there's a fire and you're the only one who can put it out. And because he continues to believe that year over year, they go ahead and snap into action and start doing their monetary policy aggressively. But overall, they didn't do anything. So Jerome Powell, they woke him up and he didn't do anything for too long, right? And so inflation was able to rise, as you can see here, all the way up to 9.1%. And then it's become a little bit less bearish for the market as it's retraced some of that movement to the upside. And now here we sit as of this morning at 6.4, which is what the print was this morning. So this is kind of the historical movement. For most of the 2000s, it has been at or below 2%. And by it, I mean inflation, as you can see here on this chart. And that trend stopped mostly as and Caleb, perhaps you could chime in on this, mostly as a precaution against the pandemic. The Fed decided to enact some monetary policy that basically made the inflation skyrocket. Now, I will say in their defense, also the supply chains that were shut down as a result of the executive and congressional branch of the U.S. government, those had quite a bit to do, and some would argue had more to do with the precipitous incline in inflation. But absolutely, they went hand in hand. The Fed's aggressive Keynesian monetary policy and the U.S. government spending for the pandemic and shutting down businesses for months and months on end had to do with why this inflation rate skyrocketed and now is so important to our crypto holdings, to our stock and equity holdings, and to all of our holdings in our portfolio. So that's a little bit of a historical context there of what we're dealing with here when it comes to inflation. It's been on the right trajectory back down towards that 2%, but we've got a ways to go, guys. So here's what I would ask Caleb. So at this point in time, it sounds to me like you aren't overly bearish on this print. It sounds like this miss, yes, it's not going to be read as we saw in the futures markets there for the S&P. We saw that it was read initially as bearish, right? And that was probably just algos that were reading a 1 and a 0, saw a 0 and sold, right? But then the actual humans got back, or more sophisticated algos got back behind the wheel and took control and said, actually, this isn't that bad. Let's keep buying. That's kind of the way that it played out this morning at time of print in those first microseconds of algo trading. But what do you think is going to happen throughout the rest of this week, Caleb? What is going to be the market reaction to this? And let's go ahead and drill into kind of that breakout of each different commodity and how it measured up in this month's reading.
Yeah, so I'm looking at the futures market right now. The S&P 500 E-minis they're now down basically 0.2%, trading lower than where we were before the CPI came out, right? So Slight contraction there, no major surprise. I think, I did another tweet this morning saying chop fest, and I think that's exactly what we're going to get. If we look at something like the US dollar index, it's still negative on the session, but it's up much higher than it was before the CPI came out. So, that's making, a pretty solid 1 hour candle right now if you have that chart up. And I think just kind of across the board, we're going to see yields push a little bit higher, especially on the short end. I'm actually kind of curious to see how that's shaking out. And look, I'm looking at Bitcoin right now. I have this, maybe I could share my chart on this really quick. This should be, can you see this?
I can. Yeah, looks good.
Okay, perfect. So we're looking at Bitcoin 2 hour candles. I've been lasered in on this green range now. Even as we were coming back down into it, I was highlighting it as potential support because, as traders and technicians will know, former resistance, we had 1, 2, 3, 4, 5 complete rejections and finally get a breakout. Once you get a breakout over a resistance range, good likelihood it acts as potential support. And that's exactly what we've been seeing. We came into that range, we wicked into it this morning with the CPI data, and now, we're kind of like fighting right on that range now, so we'll see how this shakes out. But again, we're not seeing too much actual market action. The market is, having I would say a difficult time trying to assess what the overall implications of this data are, both for the market itself, for the Fed, for the overall economy. What does it mean that inflation is coming in a little bit hotter, but is still decreasing on a year-over-year basis? I know the month-over-month reading is something that a lot of people are probably going to be focused on, and for good reason. It increased from 0.1% on the headline CPI to 0.5% versus the month of December. Mm-hmm. So that's a pretty solid little jump, right? And you can annualize that and figure out what it is on an annualized basis. I'm not going to do the math on the top of my head, but it's certainly not a great, but not a terrible number. And so at the end of the day, we saw month over month inflation, but we're seeing year over year disinflation. Overall, I think we're seeing those kind of disinflationary dynamics kind of take place. Let me pull one other thing over. We'll switch back over to the actual inflation data itself. The BLS provides this pretty epic table here looking at the...
It is epic.
Yeah. So what we're seeing here is all of the month over month readings for these different line items, and then they provide us with the year over year for the most recent data. So for January 2023, I think the big thing that we're seeing here generally is that energy, is this line item right here, was up 2% month over month, whereas the past 2 months have been pretty decisively negative. We had that surprise month to the upside in October, again, after multiple consecutive months of pretty negative prints. I think what we're seeing right now is probably a repeat of what we saw in something like October, right? It's not going to be a linear path down for inflation. So this is somewhat of a hiccup in the grand scheme of things, but unequivocally, we'll get to some other data and charts that I have prepared. We're still seeing the slope of inflation roll over and decline, right? So that's a deceleration in inflation dynamics, AKA disinflation. And it's super important to differentiate. Disinflation is not deflation, right? Because Deflation is actual prices falling versus a baseline measurement.
Yeah.
What disinflation means is a reduction in the pace of inflation, right? Yeah. So if we're driving on the freeway and we're going 80 miles an hour and we see a cop ahead and we need to slow down to 65, we pump the brakes, right? So we're slowing down, but we're still going forward at 65 miles an hour. So that transition from 80 to 65 is the equivalent of disinflation, whereas putting the car in reverse and going backwards 5 miles an hour is the equivalent of deflation, right? So it's very important to differentiate this the common mistake of disinflation versus deflation. So that's why I'm very careful to say what we're seeing is disinflation on a year-over-year basis.
Absolutely. Well, and you pointed that out so well, and I appreciate that. So what I want to do is point out some of the things that stuck out to me that I've got highlighted here. You can see on my screen here. Energy is always a really big indicator, guys, of what it's always a big impact on CPI, and we cover it every single morning. I show you guys in the market open, natural gas and oil and how it's been moving, and I've shown you guys the price charts, and that's why I do that. This exact graph, this exact table of information is exactly why I do that. And as you can see here, utility gas services printed at 6.7 increase in January, and as you can see in the past, this number has come down in October and November by more than 3%, almost 4% both months, and then it had an incline in December up 3.5%. So that was a major driver. In fact, it was on this table, it was the biggest jump. So and that's what utility piped gas is natural gas, if I'm not mistaken. Isn't that correct, Caleb?
I was actually wondering that myself.
Yeah, it's not
I'm
clear.
seeing it, and I think you're right about that. And I was trying to think about the weather implications, because I know the Northeast and New York got absolutely wrecked this year, and places in kind of like the Midwest. But then I'm looking at the year-over-year number, and it's up 26.7% year-over-year. So you make those kind of like seasonal adjustments or year-over-year comparisons versus last January, and that's a pretty big increase.
It is. Yeah. And what's strange to me is that if you go to a natural gas chart, which I always have handy because I am unfortunately in a long position on natural gas, have been since late December. If you look at that, and I'm on a 1 hour chart, so let me get down to a daily chart here for you. Natural gas has had nothing but bearish movement. It is completely from the highs back in August, which is going back quite a ways, but it's down 75%. The price of natural gas is. Now it's up today. It's up this morning in the pre-market, but that doesn't mean much. That's just daily movement. So it's strange to me that we would see a representation in this table that doesn't seem to reflect the underlying natural gas price, at least in North America. So I don't really understand this. I gotta say, and it seems like this is the biggest contributor to CPI. So it's strange to me. That's something I definitely want more information on, where that number came from, and how that got put in there. I don't know. Maybe the natural gas spot price is different, and because it's subsidized by the government or something like that. But they go ahead and include the underlying price. So I'm not sure. Not really sure about that one. But
hey Taylor, real quick, can I share something on this?
Yeah, go for it.
I want to talk about why I'm not overly concerned by this data, even though it wasn't as optimistic or as rosy as expectations were hoping for. And so what we're looking at in this chart right here is just the actual CPI on a year-over-year basis. So we can track the year-over-year percent change over time. And, we'll zoom in on this section right here, but, clearly we have this massive peak, and historically, once we've seen these kind of rotations, right, you can look at this section here in the early 90s. You can even look at this mini inflationary cycle in early 2000, 2001, what we had in 2008. Even here in 2011, once you get these rolling overs, you pretty much have a path down for quite some time, right? And, like if we look at this 1990, 1991 inflationary cycle, yeah, sure, we stabilized right here around 2.5 to 3% for several years, right? And so we might get something very similar to that right now. But nonetheless, it's like, if we zoom in on this kind of dynamic, right? We still decreased on a year over year basis. The actual number was 6.34. So they're rounding up in the official data, calling it 6.4%. But, that's it's a full 0.1% decline versus December's 6.44494, right?
Right.
They get super granular here with this data. But I think this is important to point out, right? Is like we're not seeing this big resurgence, almost like what we saw in mid 2022, where, oh, look, we might have a peak for 1 month and then we accelerate higher. We've had 7 consecutive months of disinflation, right? And so that's a good sign. And then as we kind of dig under the hood a little bit more, we can look at something like core CPI. Core CPI, this excludes food and energy prices. So Taylor and I, you and I, we were just talking about the impact there on the energy side of things. What core inflation allows us to do, this certainly isn't what the Fed is targeting in their actual inflation data, but because energy and food prices can be very volatile, this helps to reduce some of the noise and allow the Fed to contextualize some of the overall consumer price dynamics, right? So this in and of itself isn't what they're watching, but it is another tool or data point that they evaluate very consistently. Once again, we're having a deceleration here off of this peak, right? And look, that looks also very similar to what we saw in the 90s. We kind of had this like double cycle here to get the final highs on that last little print. Mm-hmm. Same kind of dynamic that we're seeing here, followed by continued disinflationary pressures. Obviously, I don't think that we're in the same environment that we had in the early 90s, but just kind of showing, right, like this isn't necessarily uncommon and continuing to move into this kind of disinflationary regime, which I believe we're kind of really moving into now. And so, this is important, right? Because the shape of this cycle is what the Fed is really focused on. Are we moving back towards our 2% target? Are we moving back towards a level of inflation that we deem appropriate? And this data that we're seeing today tells us that we are. Are we moving at the pace that we would like to? Maybe not necessarily, but we are moving in the right direction. And a win is a win, right? Like it's that classic saying, right? Beggars can't be choosers. We just had 9.1% inflation back in June of 2022. Today we're sitting at 6.4%. Hey, that's a pretty solid decline here in inflationary pressures. It certainly doesn't, and look, I did a tweet about this as well, is that inflation has peaked, but prices haven't, right? So prices are still increasing, but the rate at which they're increasing is slower, right? That goes back to the whole disinflationary discussion that we were having before. And so I think this data right here is super important because nothing that we're seeing in the January data tells us that the trend has changed or is changing. It's simply that, oh man, it didn't happen as fast as we were hoping. Mm-hmm. That's all.
Absolutely. Yeah, no, that's a really good way to break it down, Caleb. I appreciate that. I wanted to shoot over to the oil charts, the monthly candles, guys, just to give you an idea of the difference between the 90s and the present. So we're currently seeing, I don't think people look at the monthly candles very often on oil, which is why I wanted to bring it up. As you can see here, our monthly candles are closing month over month lower. So that is a really good sign. And yes, they at some points will wick higher than the previous candle body there. That did not actually happen in January to December, but it did happen in February to January. And so, and also I will note that candlestick is far from closed. We still have plenty of time on the clock for February for something crazy to happen to the February candle. But as you can see, guys, look, it came down all the way from a price of a barrel of a gasoline all the way down. I actually have to readjust because it's so high. About $130 for a barrel of gasoline, and that was in 2022. That was in March of 2022, and that was just basically it was during the pandemic. The demand for oil stopped, and also people couldn't go to oil refineries and oil wells to pull oil out of the ground. And that was fine until, as you can see on this chart, it was fine until there was a reopening, right? And people started getting back in their cars, and people started firing back up their factories, and people started to return to work. That sent the price of oil skyrocketing because there was a supply shock. There wasn't enough oil in North America, liquid oil, to go ahead and fuel our economy in the way that it did. Now, going back to the 90s, it was a totally different scenario, guys. But what you'll notice is that it was oil again that sent inflation up higher. And what that was the two Gulf Wars It was the Iranian Revolution, and these were events that sent oil skyrocketing. When Iran had its revolution, Iran was a giant producer of oil at the time, and as you can see here, there was an increase of 150% in oil prices back then. And that was in a much less efficient, much less nimble economy that we have now. There was a lot less indicators. There was a lot slower data back in the 90s. And ultimately, there was a lot more of a different type of mindset in leadership and their view of monetary policy and fiscal policy. And so it was a different time, and that's why on the chart that Caleb just showed, the inflation over time, and I have it right here as well, you can see that's why there was so much more inflation back in the 90s. This is not the 90s. The inflation chart I have here does not go back that, well, yes it does. Let's see. Back here, that's why it got so much worse that back here, and this was actually the 80s. This was when this was back when the Gulf Wars and the Iranian War revolution was closer to the 90s. But it was a totally different time, guys. And so I don't want people to think that inflation is going to go back and hit like 20% or whatever it was back then. 20, 21, 20, almost 23%. It's like what Caleb was saying. We have been on a downward trajectory. We've been on the trajectory we need to be. And there's really no reason to think that we're not going to come back into the target rate in a reasonable amount of time. Yeah, it might take till 2024, right? If we draw a line here and just do a natural slope, let's see kind of where it comes out. Now at 2025 is actually where it comes out. But you could easily draw that line here and land in February 2024, so early 2024. And those are very crude drawings, I might add. All hope is definitely not lost with this print, guys. That's definitely the sentiment I'm hearing from Caleb, and it's the sentiment from me, from your boy T-Shroom this morning. Let's go ahead and go over to the chat see what has been being discussed over there. Seer Art says core services less housing is at 6.2. That's a good thing to point out. And then Beachhead did confirm that the piped gas is natural gas. So appreciate that. And then Crimson Caravan Company said their views were crush the Soviet Union. So I think you're referring to potentially what I may have been saying about the things in the events going on in the 90s. But we are about 2 minutes away from the market open. So before we get to that, Caleb, are you seeing anything on the charts at all that are on crypto charts or any kind of futures charts that are ringing any bells for you? Have you noticed any movement since the CPI print?
Let me share my screen on this. Nothing too crazy, right? Like Bitcoin is coming back into this key support range. I've been talking about now. I've kind of added this new level on my chart, which is dynamic. If you take the anchored volume weighted average price, the AVWAP, why am I putting it here? It's somewhat arbitrary, but it also isn't, because if we kind of zoom out here and contextualize what was happening prior to this, like in my opinion, this is where we kind of started that exponential leg higher, right? Going into the start of the year. And so for me, I'm going to be very focused on how price and how buyers and sellers have reacted relative to the start of this new exponential trend that we've started in 2023. Mm-hmm. And we can see that this started right on December 30th, right? So basically right on the start of the year. And so if this green level breaks, which certainly isn't guaranteed, I kind of have somewhat of an expectation that it will, but that's just my own bias speaking. So I'll objectively continue to react to this level as price does. But if we break below it, right, there are a couple key levels that we should kind of have on our radar. We could obviously see how price is generally going to react to a range down in here. We had these multiple wicks lower. It's not a perfect level. I'm just being kind of lazy here with the analysis. But either way, this anchored VWAP is definitely going to be something to pay attention to, and that puts us right around 20.5K, right? So if we do get a flush below this level, we might see some buy activity kind of come in between 20.2, 20.3 thousand, all the way up to 20.6, 20.7. And that kind of aligns with the VWAP here at 20.55. So if this level breaks, that's what I'm watching. Looks like the market just opened right now. I got an alert. One other thing that I'd like to point out, though, is what's happening in yields, right? If we look very short-term yields, I love looking at the 3-month treasury yield. This thing is not really slowing down whatsoever. It's relatively unchanged today, only up 0.34%. So if we zoom in a bit and look at something like, let's just look at 5-minute candles here. It looks like this right here was probably when the CPI came out, ish. Well, let's see. What am I looking at here? 5-minute candles? I don't know. When did this? I'm trying to. Either way, right? It's basically unchanged, and so this is what I'm talking about. How the bond market is going to be the arbiter of truth, and it's not really giving us much of a clear signal here in terms of short duration treasuries. If we look at something like the 6-month treasury yield, okay, we got a much stronger spike, but now we're resettling back down. We'll see how this shakes out. Let's look at the 1 year. Wow. A lot more noise, but this is trending a little bit higher, right? So now we're starting to get a clear picture. Short-term bond investors, not really certain what this means. As you move a little bit further out onto the maturity spectrum, we're seeing a little bit more of decisive action to the upside, right? So they're pricing in higher for longer. 2-year, same dynamic. Okay, now we're really getting, look, I'm doing this for the first time. So we're figuring this out together and trying to do the analysis live. 5 years, same dynamic, big acceleration higher. So again, the longer we get on the maturity spectrum, basically the longer it takes for us to get our money back from the government for the bond, we're seeing decisive action. 10-year, pricing in higher for longer. 30-year, let's see what we're seeing here. A little bit less decisive, but still to the upside, right? And so this is important to kind of contextualize here because, as I've been saying, is the bond market is going to be the arbiter of truth. The problem is that what I've been saying is that the short-term bond market is going to be the arbiter of truth. And that market to me right now looks somewhat confused based on this data. Yeah. So as of right now, I don't think we have a decisive answer as to what the overall implications are, because the tea leaves in the bond market are giving us a very unclear signal, right? So that's kind of my immediate takeaway just from looking at that data live.
No, for sure. I think that we'll get a pretty solid answer by around 2 p.m. today. We'll see kind of where these 4-hour candlesticks are printing on the indexes in Bitcoin and Ethereum, and that'll give us and on the bonds, especially the young bonds, as you were pointing out there, and that'll give us a really good indication of where the market wants to go with this print. Again, there's a pretty strong argument for this being a bullish print, even though it missed expectations, and that is because big banks, big institutional, and also retail are gonna have in the back of their mind, well, there could have just been kind of an over optimism and in play in the expectations and in the forecasting by economists for the CPI print. But guys, the market is open, so let's go ahead and jump into and see what is going on in the market. How are the different asset classes reacting? Well, oil is selling off pretty big, down 2%, and we'll circle back to that and see exactly why. And then also the natural gas future contracts are up 5%, and then the natural gas ETF here, UNG, is up 3.4. So pretty interesting movements there in the energy markets. That it more than likely is unrelated to the CPI print, but it may be related. So let's keep moving here. The indexes are all red. So red on the screen, and risk is selling off the heaviest. That would be the NASDAQ is down 1.04%. And then the S&P and the Dow Jones down about a little less than 0.8% there. So seeing definitely a sell-off and a lag of selling in the security index there, the Dow Jones. So let's keep moving though, guys. Crypto, pretty red across the board, although Uniswap is holding on to its green status, as well as Litecoin. Leading the way lower is, you got to give it to Cake on this watch list, down 2%. But one thing to note here, Binance BNB coin down only 0.6%, and this is pretty big because of a totally separate story that's been going on between Paxios and the BUSD coin. The fact that BNB is not selling off heavy this morning is very, very good sign. In fact, it's up. It's being sold at a lower rate than Matic, right? It's being sold at a lower rate than AVAX. And XLM. So encouraging there for the BNB story for Binance. Let's go ahead and move into the metals, which are also selling off. You're seeing, let's take a look here at silver. Silver getting down below some key levels here that I have drawn at 2022. So that's pretty interesting. I haven't been tuning into silver too much. Let's see what's going on over in gold. Yeah, gold pulling away from that uptrending line of support that it was kind of caterpillaring on for a while. It has now fallen and is moving and gaining momentum to the downside to go back and retest that 200-day moving average. More than likely, we'll catch some support probably around here at 1825. But those are your metals, guys. Not going to linger there too long. Big cap stock, mega cap tech here selling off pretty uniformly, although Microsoft hanging on to that green status, up only 0.1%, so just barely hanging on. And then your biggest lagger there is going to be Apple, getting sold off to the tune of 1.7% here in the early minutes of the New York session. Moving down into bonds.
Hey, Taylor.
Yeah, what's up?
Real quick is when you look there at mega cap tech, big tech, are you just looking at individual names, or do you have like a overall thing that you look at?
I have an ETF. I have Bulls pulled up, which is kind of a FANG trip, but it's a triple leverage. I believe it's leverage, so I usually don't mention it.
So this will be good for you and for people watching. Is look at MGK. It's the Vanguard Mega Cap Growth ETF, and so something like 50 some. It's like the majority of the fund. It's like 55% of the fund is FANG. And then you'll also have like Visa, MasterCard, and some of the other big dogs in there.
I like that.
So this is a great way for overall investors to get exposure to big cap, to mega cap tech. And it's a good way to kind of gauge it on a daily basis as to how it's performing. But then there's another ticker that you can pull up. It's available on TradingView and other trading platforms. It's NYFANG. It's just it's the New York Stock Exchange FANG Plus Index.
Okay. NYFANG?
Yeah.
Okay.
Did that come up for you?
It doesn't come up.
Are you on TradingView?
I am, yeah. Oh, okay, I got it now. I was on just stock. So there it is.
Yeah.
This is the one that Caleb's talking about right now.
And so what this is it's an equal weighted index of 10 stocks. It's going to be all your FANG names, and then they have like your Tesla in there, you have Nvidia in there. I think they even added AMD recently, and another stock, I think it was Snowflake that they added because they got rid of Alibaba and Baidu. So two of those Chinese tech names, and they swapped in AMD and Snowflake.
Okay.
But this is another really good way to gauge what overall mega cap tech is doing, because it's an equal weighted version of all the big dogs.
Gotcha. Excellent. I love it, Caleb. Thanks for pointing that out. That's going to be very helpful on our daily journey through the market open that we do every single morning here on the Investing Bros, which, by the way, guys, if you're tuning in, we do have above average concurrent viewership today. So if you're tuning in and you are this is the first time you're tuning in, make sure you subscribe and leave us a like as well. Let's keep moving here into the bond yields. The bond yields are higher, and so is the Dixie. So basically that means that bonds are kind of getting sold off here. So those yields are having to come up to incentivize buyers to keep hold of them. That is the way that mechanism works. But let's take a look at the Dixie here, and perhaps the bonds have moved enough now to where Caleb can get a little bit of a closer reading. Perhaps not, though. I mean, it's only been a couple of minutes. So overall, though, you can see the Dixie kind of trading flat here. This is on the daily chart. So trading pretty flat here, had a bigger movement to the downside than the upside, as you can see represented in the wicks there. Zooming into the 4 hour, though, let's check out kind of the momentum here on the, I know this doesn't get bought and sold, so you have to think about it a little bit differently. It's a strength index, but the histograms on the 4 hour decelerating here. So as you can see, a little bit of upside movement there on the 4 hour for the Dixie, which is bearish for the overall kind of outlook for relative to equities and crypto. But let's keep moving. I'm sure we'll come back to the Dixie and yields before the end of this episode, which will be good. Cannabis selling off here, CGC down 1.3%, MJ down 0.7%, and then your mid-cap stocks, which Caleb mentioned, Snowflake there, which is, that's a big reason of why, because this is kind of the quintessential mid-cap stock right now for a lot of folks to kind of track, which is why I've got it here in my watch list. But then also you're seeing buying in C3.ai, which is kind of the story from last week, which is buying up the AI coins and the AI stocks. We'll go ahead and take a look at it really quickly. But you're also seeing buying in Coinbase and Snowflake, as I mentioned. But some of the other names there are selling off. Let's take a look here at C3.ai. Oh, it's wanting to show you the oil producers there, which are all down, so we can skip that afterwards. But C3.ai here, getting bought, got a decent green candlestick here in the morning. This is the 4-hourly. Overall, it's been in a downtrend ever since it had that crazy rise last week, and in early February, I should say. And now it's actually, trying to make a recovery, trying to find support, but it is still in a micro uptrend after this big candlestick down lower. So ultimately there, guys, C3.ai it's kind of one that I've continued to point out, but it hasn't yet found really great support, although its lower lows are decelerating there. So Caleb, I want to throw it back over to you. Is there anything that you're seeing out there in maybe in the Twitter world or in specific charts that's kind of giving you any indication of the way that the market is digesting the CPI print? Or are you seeing anything in general that you wanted to bring to our attention?
Let me share one of my favorite charts right now, which is just looking at Papa Dow Jones.
Nice.
Classic kind of structure here. I'm going to add something to this chart in just a moment, but let's just analyze the pure price structure. I've been sharing this chart in real time since last year. We got the clean breakout, hesitation pause here in October, clean breakout, while other indexes like the S&P 500 and the NASDAQ were struggling at the top of this channel. Mm-hmm. The defensive, value-oriented Dow Jones was able to achieve the breakout. I thought that was generally a positive sign for things. Guess what happened? We came right back in, we retested the channel and used that perfectly as support. And now what we've been doing is we've been flagging in this. You can call it a pennant, you can call it a flag, you can call it a wedge, whatever you want to call it. I see a triangle here. And guess what? We closed yesterday. That was the highest close that we've had since earlier in the year in mid-January. And today we're seeing a little bit of selling pressure, but as far as I know, the Dow is holding up better than the other indexes. That's not much of a surprise when we consider the fact that the Dow is generally considered to be the more defensive oriented index.
Right.
So no major surprise, but if you like technical analysis, this is telling us that it's not really much of a surprise that we're seeing key movement take place here, whether it was a breakout or a rejection. All we knew going into this report is that we were trading at a key level based on this structure. The one thing I want to add on to here is this 200-day moving average cloud. And, we talked about how we got this key breakout. We came in and we retested the channel once again. But guess what that also aligned with? That aligned perfectly with the 200-day moving average cloud, right? So we have the exponential moving average in teal. We have the simple moving average in yellow. That, flipping this into support is a major win, because as we can see, we fell below it for the first time in January. We tried to get above it. We couldn't use it as support in a sustainable manner, right? We tried to rally here. We made higher highs, but it failed.
Yeah.
We come into this rally here in March, April, even going into late April. We couldn't stay above it. We fall and make new lows. Same thing happened here during the August rally. We have this massive rip higher in the index, rallying basically 16% over a couple months.
Wow.
Guess what? We basically get rejected on that moving average cloud. At the very least, we couldn't stay above it. Same thing there in that October rally until all of a sudden we do stay above it and we flip it now into support. I think personally, this is a really key win, because if we go back a little bit further, let's look at the COVID dynamic. We slice right through that moving average. That's fine. We couldn't get above it here. We struggle. But then guess what? As soon as we sustainably flip it into support, boom, retest, rebound, boom, retest, rebound. Guess what, guys? We went on a massive rally here. So I was highlighting this in real time as we came in and flipped this into support. And I was saying, look, nothing's guaranteed as always, but as long as we stay above this 200-day moving average cloud on the S&P 500, that's pretty good news.
Yeah.
And if we look at something like the Russell 2000, we're seeing the exact same dynamic. Small cap stocks. This was support, support, support. We flipped it into resistance, flipped it into resistance, resistance, resistance. We had resistance here. Like, this doesn't get much cleaner. And guess what? We flipped it into support. We've been making new relative short-term highs. That's a great, great sign, right? So again, for the S&P 500, for the Russell 2000, for small caps, we're seeing generally that same dynamic. So long as we stay above that level, I think we have a kind of line in the sand here to stay bullish on market dynamics. As we look at other things like the S&P 500, we haven't actually flipped this into support yet in a meaningful way. You could argue this retest here, but I didn't see enough of an extension here in this range to really qualify this as a support retest and rebound. I still think personally we'll probably come back and retest this 200-day moving average cloud pretty soon. I think I initially thought sooner rather than later. We've been holding up stronger than I had expected. But look, if we get that pullback, this 200-day moving average cloud aligns once again with the top of that channel. Yeah. So pretty interesting confluence there. If we get it, if the S&P 500 falls 4% and we come into this range, I'm going to be a big buyer for stocks, right? So I'll move in with some size in my long-term positions. It wouldn't be a first short-term trade. I just want to be very clear. But if we do come back into this, let's call it the 4,000 to 3,900 range, I'm going to be a pretty big buyer of stocks in that level, with willing to accept the fact that I could be wrong there. Yeah. NASDAQ 100, this really acted as resistance very decisively. Yeah. 3 times at least, right? And again, we haven't necessarily flipped it into support. We almost got a retest last Friday, but we didn't quite get there. I think, tech is looking the weakest overall from a long-term structure perspective. And so I think we'll see the retest here fairly soon for the NASDAQ because it's just the most achievable, right? For us to fall and get back down into that range is a 3.5% decline. The thing to watch right now is look at what the NASDAQ is doing relative to the open. We're almost about to flip positive for the session. The index basically is up 0.8% from the open. And, that's a pretty interesting sign here. I think once again, the market had some initial fear with respect to the CPI data coming in hotter than expected. But like I said, when we started this at the top of the hour, a win is a win, right? And so nonetheless, this data doesn't, all this data does is show us that we're still in a disinflationary environment. And fundamentally, that's all that matters, is that the pace of inflation is slowing down.
Yeah. No, absolutely. I appreciate that run through the indexes there. We cover the indexes every morning, and I try to educate a crypto savvy audience on kind of the indexes. So Caleb kind of hitting home the importance of looking at summaries of the New York stock market there, because they are very important. Now, Caleb, you said that you're going to maybe move some weight into your long-term portfolio into stocks. Are there some names that you could potentially talk about that you were overly bullish, or not overly bullish, that you're bullish on for kind of the long term there? I think one of the names that I really like that's kind of underbought right now is Amazon. Is there anything that sticks out to you that you'd be willing to share?
I'm happy to share. Definitely subscribe over to my Substack. This last weekend, I talked about 2 new companies that I've been buying, in addition to 2 other stocks I've already been buying that I just recently repurchased. That was for premium members, but you guys are premium family to me, so I'm happy to share what those stocks were in our chat today. So one thing that I've overall been doing is I've reduced my exposure to some of the names that have just really gone exponential this year. So I sold my entire position in NVIDIA and another semiconductor company called Lam Research. Both of these stocks, when I sold them, were up 83% and 100% since the lows in October. And so when you have stocks that move up that much, I was underwater on them because I was just dollar cost averaging during a bear market. Yeah. And so I had an opportunity to get out at a profit. And I think the stocks are overextended. That doesn't necessarily mean that they can't keep going higher. They definitely could. And, I'm prepared to watch them move higher. Yeah. But after such a substantial run for something like NVIDIA, I felt like it was a good idea to de-risk. So what am I buying? 2 stocks that I've already been buying that I increased my exposure to. Let me share my charts on this as well, because it'll help to provide some context. Go for it. Overall. One of them is Google. With the resurgence of Microsoft right now, everyone seems extremely bearish on Google. I was very impressed with their earnings report, even though they showed, decelerating growth rates overall. The thing to keep in mind here is with Google, and look, tell me if I get too granular, but the company has $20 billion in cash and over $90 billion in cash equivalents. What are cash equivalents? They're short-term treasuries. So maybe 6 months, 1 year, 2 year treasuries. Yeah. And so they're generating a pretty solid yield on that, and they have $90 billion worth of it. And I think if I remember correct, they have about $15 billion in long-term debt. Mm-hmm. So if they wanted right now, Google could pay off all of their debt and have, excuse my language, but a shit ton of money left over to survive a recession, to invest in R&D, anything that they want. So, please show me any company right now that basically has $120 billion in cash, because I'd love to be buying that stock right now. Google meets that qualification for me. And so I like that kind of defensive position. And look, keep this in mind, right? If we go from the 52-week highs to today, the stock is down 38%. For it to make new all-time highs, right, the stock is going to need to gain 62%.
Wow.
Right? If that takes 3 years for that to happen, and I need to, sit around for 3 years before the stock makes new all-time highs, but I gain 62%, I'm basically securing a 19 or 20% annualized return, whereas the market historically is going to give you 8 or 9%. So you're more than doubling the historic average gain for the stock market by buying Google today. Does that mean it can't go lower? No, I expect it to go lower, but I'm still going to be buying the stock, right? So Google is one name that I'm buying. Yeah. Another stock that I'm buying, Republic Services Group. Most people are going to have no idea what the hell this company is.
I don't.
But I guarantee you, they service most of America. What are they? They're a waste management and collection services company. So they're a utility stock. They pay a small dividend of 1.5%. It's nothing great, but it's enough. And I mean, let's zoom out here, okay? Let's look at, let me get rid of these corporate actions down at the bottom. Let's look at this on a weekly chart for as long as we can.
Wow.
Like this looks like Microsoft. This looks like Google. This looks like Apple. And what do? They're doing nothing innovative. All they're doing is stopping by your neighborhood and picking up your trash.
Yeah.
Right? This stock is a massive, massive compounder over time. And it's surprisingly defensive because it's a utility stock. Utility stocks often provide a level of defense and protection within an overall portfolio because they're going to pay you a solid dividend. They have very stable cash flows. They don't really grow very much. Yeah. They're just steady performers. And guess what? Trash isn't going anywhere anytime soon. If anything, as the population grows, trash and their fundamental business is going to grow over time with demographic trends. Yeah. So this is something to watch. You'll also notice the stock is actually negative year to date, even though the broader market is up. So as I look today to allocate money, I want to allocate into things that are technically underbought relative to the market on a short-term basis, especially when the long-term chart looks like this, right? So RSG is something that I've been buying. Now, I teased that I'm buying 2 new stocks for the first time. One of them is Extra Space Storage. They're the nation's second largest self-storage real estate investment trust.
Oh, cool.
So Public Storage is number 1. They just had a pretty big merger or acquisition of Life Storage. So PSA is going to be the largest by far. But this company pays like a 3.5 or 3.6% dividend yield. They're down substantially from those all-time highs, right? The stock is down 29% from the all-time highs. I started buying them at the beginning of the year, but I bought more shares again last week. Again, I'm just building out this position over the course of the last month and a half. So very new position for me. But again, right, look at the long-term performance on this sucker. It looks, again, like a tech stock over the long run. Yeah. I mean, even if we just rewind to the beginning of 2014, the stock is up 290%. So what is that, 3.9x? Yeah, exactly. It's 3.9x. So that's a massive return over a 10-year period. You just almost 4x your money. And they pay you a fantastic dividend. So I love Extra Space Storage. They're still growing at a really solid rate. They have earnings coming out, I think, this week or next. So I'll be certainly watching for that. I'm also buying another real estate investment trust, DLR. This one's super interesting to me. It's a data center real estate investment trust.
Okay.
So they lease out buildings that have massive servers for companies to tap into for cloud, for internet, for whatever the case is. So if you like technology over the long run, you know for a fact that we're going to become increasingly reliant on data, on cloud, on internet infrastructure. And this company owns real estate properties that do exactly those things and set up the infrastructure. And they pay a massive dividend of it's like over 4%.
That's awesome.
So I'm going to get those dividends reinvested into buying more shares and allow this sucker to compound over time. The long-term chart, I think, is really good. It's nothing spectacular. You'll go through a lot of chop, but if I have the opportunity to reinvest dividends and, you know, I can increase my wealth by 4.5% on an annual basis by buying more shares, I actually want this thing to go sideways or dip a little bit because it allows me to accumulate more shares for the long run. So I'm happy to sit in this. Again, these are long-term positions I expect to hold for the next 5 to 10 years, ideally. And I might sell some in this time and sell some at that time, but I plan to continue buying these things over the next 5 to 10 years.
Absolutely, dude. Big ups. I really appreciate you sharing those. For those of you guys who don't know, you know, Caleb just gave you guys some very, very good tips right there. Not financial advice, but definitely go check out. He is the second link in the description is Caleb's newsletter. Definitely go check that out. He's got a free one, so you can subscribe to that and kind of see the sauce that he's working with, and maybe you want to bring that relationship further. But I really like what you pointed out because you know, a lot of people sleep on the defensives, but I wanted to show you guys, this is actually a stock that I bought down at the bottom of the pandemic, Waste Management, which is very similar to one of the picks that Caleb just showed there. And I was able to hold it for a while. And as you can see here, it is actually in a similar spot to the management company that Caleb was pointing out. But don't sleep. Just, you know, here's the thing, guys, is like a lot of people who are watching this are in crypto and you're in NFTs and things like that. But if you want to really be financially free come retirement, you have to also think more conservatively. And while, you know, Caleb and I both would be, you know, leap to make an argument for why Bitcoin is one of the best retirement investments that you can make, you also need to diversify into some of these standard staple investments that have made people wealthy since, you know, the founding of this country. You know, my grandfather and my grandmother lives off the dividend income from the companies that my grandfather bought stock in. Were those high, you know, tech companies? No, they were just pharmaceutical companies and they were energy companies. Don't sleep on adding these utility companies to your long-term portfolio. Are they going to be volatile and great to trade? No. I mean, sometimes if you can figure it out, but no. On whole, these are just companies that you wait for something like a pandemic and then you buy a bunch of it. I unfortunately sold off more than I wanted to, but here we go, guys. So thank you guys so much for watching. We're wrapping up the show here, but before we do, go ahead and like and subscribe, and let me get into some of these crypto stories that we didn't really get to very much, but I want to get them in here at the end before I give Caleb a chance to talk a little bit more about what he does with the newsletter. But let me go through these headlines really quick. So FTX's Turkish entities are dismissed from the U.S. bankruptcy proceedings. A U.S. court has approved an earlier request made by FTX to leave its Turkish entities out of the domestic bankruptcy proceedings. So that is going to be an interesting one to follow, especially if you are, you know, you have some money still in FTX and are wanting to get some of that back. Now those Turkish entities are not up for grabs. Well, Biden is expected to name Fed Vice Chairwoman Lael Brainerd as the top economic advisor, according to Bloomberg. Let's take a look here at some details. There's Brainerd, though, right there. So recent volatility has exposed serious vulnerabilities in the crypto financial system. This is a quote from Brainerd. She said in a speech in London in July of last year. So that was before everything that happened with FTX and Luna, actually, and Celsius. The list goes on and on. Brainerd said that the Fed has been closely monitoring recent events where risk in the system have crystallized and many crypto investors have suffered loss. According to copy of the speech, strong regulatory guide rails will help enable investors and developers to build a resilient digital native financial infrastructure. So overall, you know, kind of from what this CoinDesk article is indicating, I'd have to say that she's probably a bull overall, meaning that she's a proponent for crypto, but she wants to see much stricter regulation. So she is now advising the president of the United States, and it's important to know that, and there'll be a lot more research and a lot more details to come on whether or not her appointment is a boon or a bust for crypto. The SEC, moving on to another story, the SEC to make it harder for hedge funds to work with crypto firms. The rule change would make it harder for crypto firms to become qualified custodians, according to the report. So that of course, is coming at the hand of your boy, Gary Gensler. Well, Caleb, that is going to wrap out our crypto news. I had to go through here super quickly. Actually, one more. Sorry, guys. Paxos says it's prepared to vigorously fight the SEC lawsuit. So yesterday, the SEC came down pretty hard on Paxos and said that it needs to stop minting BUSD. That's why I pointed out in our market open that it's a good thing that BUSD is not selling off. And as you can see here, BUSD is continuing to not sell off. It's actually getting bought to the tune of 1.7% here in the early minutes of the New York session now at 10 a.m., excuse me. So overall, it looks like the market is taking in stride this CPI print that is by far the biggest headline today. We had some crypto news, but Caleb, thank you so much for coming on and sharing so much valuable and in-depth insights on not just the CPI, but also some of the stocks that you're looking at, including Google, which, you know, has actually been, in my mind, kind of had a negative connotation as it's losing the competition to Microsoft. But you make an excellent point. With as much cash that it has on its balance sheet, it is positioned to take advantage of maybe whatever the next AI is, right? Whatever that next innovation is, it can deploy a bunch of capital. And there's a lot of things on the horizon, guys. What was it? I can't remember exactly, but there's all kinds of things on the horizon. I mean, nuclear fusion. If Google wanted to get involved with that, they certainly have the cash to buy up whatever startup company actually nails down nuclear fusion, is able to take that to market. So who knows what is in store for the future of Google, but absolutely thankful to Caleb for coming on today. Caleb, let us know a little bit about where we can find you. We've got some links in the description, Caleb's Twitter and his newsletter, but just let us know what can we expect if we engage and we follow you on the beautiful thing we call the internet.
Yeah, so check me out on Twitter, 100%. We're growing pretty quickly over there. I think we just crossed 26,000 followers. So again, I'm posting everything from macroeconomic commentary and data and charts to stock market stuff, looking at the overall indexes, individual names, so on and so forth. And of course, Bitcoin and crypto kind of dynamics overall, right? So, you know, for example, since yesterday, I've really been pounding the table on this green range, talking about it as a potential support zone. What are we seeing this morning? Look at this perfect rebound right on that range again after we retested it, right? So Bitcoin is bidding up right now, back over 22,000. I don't know how long it's going to last, but we continue to see this green range get defended. And look, I'm sharing this chart for free on Twitter and providing updates. So if if you're at work and you want to, be in touch with some of the key things I'm taking a look at, definitely follow me on Twitter because I'm posting there a bunch of times each day, new, insightful, original research. And then definitely check me out on Substack, Cubic Analytics. This is my newsletter. We're just about to cross 4,100 today, free subscribers.
Wow.
So I do a free weekly newsletter. I'm covering macroeconomic stuff. We talked about yields a little bit this morning at the start of the session. I was reviewing a lot of that stuff on Saturday's newsletter. So every Saturday, you'll get a free report from me going over macroeconomics, going over the stock market, different things that I'm seeing here. We're talking about earnings growth and all that kind of stuff for the S&P 500. And then, of course, looking at things like Bitcoin. So every single report, macro, stock market, Bitcoin, I call it Cubic Analytics because I'm focusing on these three main pillars. So if you're interested in one of those things or all three of them, there's going to be something in there for you. And then on top of that, every Sunday I do a premium research report where I'm talking about, really in-depth insights for the stock market and Bitcoin. So like I said, I did a full breakdown here on why I'm buying Google, why I'm buying RSG, why I'm buying Extra Space Storage and Digital Realty Trust. And so, I'm happy to provide that alpha for you guys and your audience, Taylor, with Investing Bros. Mm-hmm. But if you want these kind of updates from me frequently, every week, every Sunday, you'll get a premium report in addition to the free report. I mean, these are lengthy reports, but they're pure alpha. So definitely check that out. I'd love to have you even as a free subscriber. So come support Cubic Analytics, man. Get on over there.
Do it. And you will see me engaging in almost every tweet that Caleb tweets. It's hard to keep up because he's a frequent tweeter. But guys, we're a couple minutes over here, so let me wrap this up for you. Overall, it looks like the markets are reacting positively to the CPI print. Your indexes are up, including the Nasdaq is up 0.7. And actually, it's an interesting sign that at this time of me talking, the Dow is actually in the red, and as I'm saying that, it now ticked back into the green. But interestingly enough, it definitely looks like the market is interpreting the CPI print as bullish. But as we have seen so many times before, major economic developments like this really play out over the days and weeks. So we'll see how the markets react as major journalists and major bank representatives come out and make statements on what the CPI print means and how the markets react to those statements. So guys, thank you so much for tuning in today. I've been T. Shroom. Tim will be back on Thursday. He'll be coming back strong, refreshed. Hopefully he doesn't have any crazy tumbles on the dunes, on the snow mountain there. I can't remember. I'm a Florida boy.
On the slopes.
I'm clearly showing my Florida colors there. But thanks so much, guys, for watching. We will see you, and we will see you in the next video. Peace.